China may have just outplayed the United States in a battle Washington thought it had under control. Scott Bessent demanded Beijing abandon its currency tactics, but in a twist, it was the US dollar that took the hit. Now, American factories are suffocating under their own tariffs. Ocean freight coming from China has dropped by 60%. Retail shelves could begin to empty within 5 weeks, and Washington is scrambling. President Trump has pressed the United Kingdom to sever ties with China, but London has responded with silence. Meanwhile, Beijing is staying patient and strategic. This isn't just policy, it's full-scale economic warfare. What happens when your top ally stops playing by your rules and your biggest competitor starts making new ones? Bessent's push for China to keep the yuan strong while allowing the US dollar to weaken wasn't just risky, it may have backfired. Since January 2025, the US dollar index has dropped nearly 10%. But instead of reviving US manufacturing, it's driving up costs in supply chains that still depend heavily on Chinese components. The tariffs from Washington, some as steep as 145%, were meant to pressure China into turning inward. But without a fully built domestic supply chain, the falling dollar is now causing inflation, not a surge in exports. You can't devalue your way out of a supply crunch, said Mark Zandandi, chief economist at Moody's, in a recent note. He warned that tight inventories and higher import prices are creating a perfect storm. Meanwhile, China's currency, the yuan, has stayed remarkably steady, falling just 3.2% so far this year. Beijing isn't retreating, it's observing carefully. And with $17.2 billion in net short bets against the dollar last month, based on CFTC data, global investors are betting that Bessent's strategy is unraveling fast. Between January and April 2025, the US dollar index fell from 105.2 to 94.8, according to Bloomberg, a drop that should have boosted exports. Instead, it raised production costs for American manufacturers still dependent on Chinese parts. In contrast, the yuan has only dipped slightly, a big difference from the 14.5% fall seen during the 2018 trade war. As Bessent called for a stronger yuan and a weaker dollar to balance global manufacturing, China moved quietly. In March, the People's Bank of China lowered its one-year loan prime rate to 3.35%, boosting domestic consumption without triggering currency shocks. Now, the falling dollar is working in China's favor, says HSBC strategist David Bloom, who warned that a soft dollar without a homegrown industrial base creates stagflation, not export growth. The very contradiction Bessent couldn't solve is now being used by China with skill and patience. U.S. retailers are stuck in a countdown. As of April 2025, shipping volumes from China to ports like Los Angeles and Long Beach have plummeted by 61%, according to Flexport and Panga data. The National Retail Federation, along with major brands like Walmart and Target, warned that inventory shortages could begin within 5 to 7 weeks if imports don't resume. The main cause? Tariffs now ranging from 75 to 145% on essential goods like electronics, auto parts, and clothing. Prices are rising everywhere. UBS reports that the average landed cost of consumer electronics is up 32% compared to last year. Imported furniture is 45% more expensive. In March, the Consumer Price Index for core goods jumped 1.1%, the largest monthly increase since 2021. It's a sign that broken supply chains are pushing prices higher. Still, Washington insists these tariffs are only a temporary tactic. If that's true, then time is running out fast. When Bessent imagined a reset of global manufacturing led by the United States, he missed one critical fact. America's industrial base is still unfinished. According to the Federal Reserve's March 2025 Industrial Production Report, U.S. factory output shrank by 0.6% compared to the previous month, and capacity utilization slipped to 76.8%. These are clear indicators that efforts to bring manufacturing back to American soil are still falling short. At the same time, core producer prices rose by 1.3% in the first quarter, mainly due to rising costs in construction materials and imported machinery, both of which remain heavily dependent on Chinese supply chains. And the labor market isn't bridging the gap. The Bureau of Labor Statistics revealed a 17% year-over-year decline in job openings in the U.S. manufacturing sector as of February. Without reliable supply inputs, trained workers, or robust domestic production, a weakening dollar turns into a burden, not a benefit. Economist Mohammed El-Iran, speaking at a Bloomberg panel, summed it up clearly. This isn't dollar diplomacy, it's dollar dysfunction, and the markets are reacting. Beijing's central bank has moved strategically, using the dollar's decline as cover to implement targeted stimulus efforts while maintaining export strength. Since February, the yuan has stayed within a pretty narrow band, between 7.19 and 7.25 against the dollar, even as the US dollar index dropped. That consistency has allowed the People's Bank of China to pump over $1.5 trillion, or around $210 billion, into state-owned banks through low-interest lending programs, according to Kin. Meanwhile, China's exports are holding firm. In March, the country posted a $13 billion trade surplus, driven by a 17% jump in exports to ASEAN countries and Latin America. Customs data suggests China is basically buying time to shift toward domestic-led growth without risking capital flight, said Alicia Garcia Herrero, chief economist for Asia-Pacific at Natixis. China's approach isn't reactive, it's calculated. By keeping the yuan steady as the dollar weakens, Beijing is safeguarding both its industrial base and financial agility. Now, the UK finds itself caught between aligning with US geopolitical demands and protecting its own economic interests. As Washington ramps up pressure to curb trade with China, Peter Navarro's April 2025 comments in The Telegraph, calling Britain a compliant servant of Communist China, came alongside a quiet push from the US, urging London to block Chinese goods rerouted from the American market. But the trade numbers just don't justify a sudden split. In 2023, China made up 7.3% of UK imports and just 4.1% of exports, based on ONS data. Severing those links would immediately impact key industries, especially electric vehicles. British EV makers rely heavily on Chinese batteries and components, and for now, there are simply no ready European alternatives. Chancellor Rachel Reeves didn't hold back when asked about the UK's economic relationship with China. Her response was clear and firm. It would be very foolish not to engage with the world's second-largest economy. This wasn't just a passing remark. It was a message both to critics at home and to allies abroad that the UK is taking a different path from the United States when it comes to dealing with Beijing. At the same time, a revealing development is unfolding in the financial world. The London Stock Exchange is considering allowing Shine, a Chinese firm, to proceed with its initial public offering. This is happening despite strong criticism from both major political parties in the UK Parliament. This move shows that, beneath all the noise, economic pragmatism still holds ground in London. The UK is weighing its options, and it seems less willing to sacrifice economic opportunity for the sake of political alignment. So the question isn't whether Britain wants to comply with US demands to distance itself from China. The real issue is whether it can afford to, without risking serious damage to its own economic future, particularly its industrial sectors. Meanwhile, voices from across the Atlantic are raising alarms. Peter Navarro, a former Trump trade advisor, lashed out at the UK in a strongly worded article published in The Telegraph. He accused Britain of behaving like a compliant servant of Communist China. His message was loud, clear, and full of fire, but it wasn't enough to sway London's current direction. In fact, Reeves pushed back in public, warning that cutting off ties with such a massive economic partner would be a dangerous mistake. Why? Because the UK is already facing major economic challenges, like stagnant productivity and growing trade deficits. Now is hardly the time to shut the door on one of its largest trading partners. Let's look at the numbers. According to the Office for National Statistics, China accounted for £62.6 billion in UK trade during 2023. That's nearly 7% of all UK goods traded globally. And this isn't just about consumer electronics. We're talking about critical sectors like electric vehicles, medicine, and manufacturing. These industries rely heavily on Chinese imports and investments. In fact, while Washington is busy trying to decouple from China, the UK seems to be moving in the opposite direction, by pursuing more Chinese investment. One key example is the Shine IPO, which could bring significant Chinese capital to London's financial markets. This move signals a divergence in strategy, a sign that Britain is seeking to restructure, not retreat, from economic ties with Beijing. We also now know that this is not happening without internal debate. A leaked cabinet briefing, reported by The Guardian, revealed that some senior officials inside the UK government are pushing back hard against Washington's pressure. One top advisor even called the U.S. approach economically self-destructive. Britain is choosing a more careful, balanced route. While the U.S. escalates its trade war, the UK is quietly choosing resilience over full alignment. Navarro isn't backing down. In an April speech, he used a dramatic metaphor. If the Chinese vampire can't suck American blood, it's going to suck the UK dry. But this vivid language doesn't reflect reality. In truth, China's direct investment into the UK actually fell by 27% year over year in 2024, according to data from the Rhodium Group. There's no surge, there's no takeover. In fact, British authorities have taken a much firmer stance than Navarro gives credit for. They've already blocked Chinese involvement in sensitive sectors, including nuclear energy and telecom infrastructure. Perhaps the most well-known case is Huawei's exclusion from the UK's 5G network, a decision made after strong guidance from MI5 and national security advisors. So while Navarro paints a picture of Britain surrendering to Beijing, the facts tell a more nuanced story. As Fiona Hill, former National Security Council advisor in the US, puts it, the UK has taken calculated steps, not capitulation. There is a big difference between engaging strategically and blindly following. The problem lies in turning foreign policy into emotional arguments. Inflammatory metaphors don't make good policy, and Britain understands that. For London, global trade is a negotiation, a back and forth, not a war to be won or lost. The UK seems to be betting that moderation and long-term strategy will be more valuable than short-term political gains or pressure tactics. Both China and the US are under pressure at home, and that changes the nature of this economic standoff. It's no longer just about who holds more leverage, it's about how things look, both domestically and globally. In the US, Donald Trump is struggling to defend his economic policies. The economy contracted by 0.3% in the first quarter of 2025, and real wages dropped by 1.1%. Still, he's trying to spin tariffs as a political win, even though they've caused a spike in import prices. It's a tough sell to American voters. Over in China, President Xi Jinping is also facing challenges. Youth unemployment sits at 5.3%, and the country's property sector is under serious strain. Housing starts dropped a massive 22% year over year, according to China's National Bureau of Statistics. Both leaders are managing economic pressure, and both are trying to project strength. According to Dr. Wentai Sun from the Australian Center on China and the World, this is now a two-level game. That means both Trump and Xi aren't just playing to each other. They're performing for their own people, too. Each move in this trade chessboard is meant to look like a win at home, even if it complicates global relationships. In this new landscape, Britain isn't picking sides. It's balancing. And that might just be the smartest move of all. Trump's message is all about bringing back America's industrial strength. China, on the other hand, focuses on resilience and a world with many strong players. Neither side can afford to make the first move, because every customs declaration doubles as a campaign message. And as political pressure grows at home, so does the chance that emotion-driven decisions will replace sound economic thinking. Both Washington and Beijing say they're open to negotiations, but, behind the scenes, neither wants to be the one to step forward first. China's Ministry of Commerce says it's evaluating talks, while U.S. Treasury officials claim the door is always open. But this gray area is intentional. A Weibo account linked to China Central Television put it clearly. The U.S. is the more nervous party. Meanwhile, U.S. Treasury Secretary Scott Bessent told IAF delegates that there's real potential for a breakthrough if China is serious. This kind of vague messaging is part of an old diplomatic move known as constructive ambiguity, once used in Cold War arms talks, now reused in this modern trade battle. It's all about saving face while quietly testing for middle ground, explains Jia Chong from the National University of Singapore. From the outside, the world sees two powerful countries locked in a stalemate, but beneath the quiet, both sides are still making moves. Neither wants to speak first and lose the narrative. By late April 2025, data from the CFTC revealed $17.2 billion in net short positions against the US dollar, up from $9.8 billion in January. This wasn't driven by speculation, but by weakening economic fundamentals. Bloomberg's dollar index has dropped almost 10% this year, pulled down by trade gaps, shaky policy, and a steep drop in imports. At the same time, the yield gap between 10-year U.S. Treasuries and Chinese government bonds has shrunk to just 32 basis points, the closest since 2006, making U.S. assets less attractive to global investors. This is about more than just trade now, said Ruchir Sharma from Morgan Stanley. The dollar is paying the price for America's lack of industrial readiness. China, in comparison, is allowing its yuan to gradually float while rolling out a 1.5 trillion yuan stimulus, without sparking a capital flight. The same financial system that once reinforced U.S. dominance may now be working in reverse. If the dollar continues to slide, China might not need to retaliate at all. They can just wait it out. The trade war isn't a U.S.-China issue anymore. It's spilling over into a larger global shift. WTO data shows that in the first quarter of 2025, China's exports to BRICS countries jumped 19.4% year over year. Meanwhile, exports to the U.S. dropped by 31.7%. At the same time, internal trade within the EU went up 12%, powered by strategic stockpiling and diversifying suppliers. The UK, caught in the middle, is trying to strike two different deals. One with Trump's administration, which wants fewer barriers for U.S. farm goods, and one with Brussels to keep smooth trade with the EU. This is the stress test for globalization 2.0, said Adam Tooze, historian at Columbia and author of Shutdown. If countries are forced to pick between the dollar's security and China-backed affordability, alliances may start to break apart. What comes next may not be a new global bloc, but a messy web of shifting trade ties, based less on politics and more on inflation, wages, and shipping costs. The world isn't breaking apart, it's just changing the price tags. So now here's the big question. Who's really shaping the future of global trade, governments or investors? Is this just a chapter in a long standoff? Or are we witnessing the rise of a new world order without a clear leader? Drop your thoughts in the comments. If you're enjoying this breakdown, make sure to like and subscribe.